Hey everyone, thank you very much for joining me. This is the morning market review. My name is Russell Shaw. I'm a senior market specialist, and my email address is rshaw@fxcm.com. And today is, good grief, it's Monday, and it's the 5th of September 2022. Just going to bring up our high risk investment warning. Rob, I saw your email. I'll reply to it today. So thanks very much for sending it. Very interesting email. I shall give it some thought. I hope everyone had a good weekend, and I'm just going to bring up the market commentaries disclaimer. And here's our references. Again, I'm using Bloomberg.com as opposed to the CNBC note. I just feel that CNBC note has, it's not quite as detailed as it was. I'm happy to be led by what you guys prefer. So you just let me know if you're happy with the Bloomberg, which is that article, the 5 things to start your day. Otherwise, we'll go back to the CNBC article. I think they give fairly similar type of information. We'll look at market scope and of course trading view. I think trading view is looking very interesting at the moment. Morning, Howard. Nice to have you in the webinar. I hope you had a good weekend, and thank you very much for signing in. Thank you everyone for signing in. Just going to go through the Bloomberg email first, which is the 5 things to start your day. The first item reads emergency meeting. European ministers will discuss special measures to rein in soaring energy costs, from natural gas price caps to suspension of power derivatives trading, as the bloc races to respond to the deepening crisis. The Czech Republic, which holds the European Union's rotating presidency, is set to include those tools on a list of emergency intervention options to be discussed at a meeting of energy ministers on Friday. The intensifying energy crunch in Europe is putting further pressure on the euro after Russia shut off key gas taps, signaling a cold and difficult winter ahead for businesses and households. The governments of Sweden and Finland decided to create emergency backstops to help utilities struggling to trade on power markets, while Austria will cap power prices for households. The next headline is the wait is over. The UK will finally find out Boris Johnson's successor as Prime Minister. After a bitter Conservative Party contest between Foreign Secretary Liz Truss and former Chancellor of the Exchequer Rishi Sunak, Truss 47 is the bookmakers' odds-on favourite to become the Tories' 4th leader in just over 6 years and inherit a dismal economic outlook. The next PM is facing a currency near the lowest in decades, an unprecedented surge in government borrowing costs, and record underperformance in domestic stocks. The result is due to be announced at 12:30 PM in London. The winner will take power on Tuesday after meeting with Queen Elizabeth II. The next item reads levy windfall. Germany's government expects to receive a large revenue boost by tapping windfall profits generated by energy companies if they keep benefiting from disruptions in Europe's electricity market, Chancellor Olaf Scholz said. Germany will take in many, many billions of euros under this scenario and would use the revenue to help consumers hit by rampant inflation, Scholz said in an interview with broadcaster ZDF. He was also confident that Europe's biggest economy won't face power blackouts. Another fight for Credit Suisse. Credit Suisse Group's next legal battle unfolds in Asia as a local subsidiary stands trial in Singapore, accused by a billionaire client of negligence he says cost him as much as $800 million. Bedzina Ivanishvili, I'm going to battle pronouncing this, Bedzina Ivanishvili, a Georgian tycoon who was once his country's prime minister, is expected to testify via video link on the opening day of the trial, which comes just months after his victory in a related clash with the Swiss bank's Bermuda Life Insurance Unit. The dispute adds to the problems that newly appointed Chief Executive Officer Ulrich Körner and Chairman Axel Lehmann are keen to resolve as the bank reels from reputational hits in the last 2 years. Coming up, Europe's deepening energy crisis has sent the region's stock futures and the euro tumbling. OPEC Plus meets to set production levels for October after Saudi Arabia flagged the possibility of a reduction. Bank of England policy maker Catherine Mann speaks at a conference. There's a slew of PMIs from countries including Sweden, Germany, and the UK. On the earnings front, it's a quiet day with US markets closed for Labor Day. All right, I think with all that said and done, let's get some analysis going. It's worth actually just having a quick word about this OPEC Plus meeting. I'll just bring up this chart here. This changes to Brent. All right, so energy prices are obviously considerably weaker than they were when they hit their peak. I calculated roughly down about 30%. And the obvious question is, will OPEC Plus introduce some supply cuts? And I think that's more than likely, by the way. I think they want to send quite a strong message, specifically because of the politics between the Saudis and the Iranians. So I think that the Saudis would be more than willing to cut supply at this point. So that's just something to keep at the back of your mind. All right, let's go back to this chart over here. Hey Anna, good morning to you. Nice to have you on the webinar as always, and I hope you had a really good weekend. All right, so what we've got here is the real rate. So this is generally how we've been starting the webinars for quite some time. And I think that it's a good way for us to start the webinars, because I think that the rate movements now are effectively the key driver in financial markets. And there is obviously a very bullish type of setup here on we're looking at the weekly chart. And this is real rates, okay? So the real rates are sitting in what we call zone 1, and that is between the upper red and the upper blue. And the longer it stays in this zone 1, okay, the greater the likelihood of rate appreciation, yield appreciation. Now, we have pointed this out previously. The Bollingers are starting to squeeze, and a squeeze in the Bollingers, whilst again nothing is guaranteed, there is a branch of Bollinger theory that says when the Bollingers squeeze, it's effectively the precursor before an expansion in volatility. So if there is that expansion in volatility and the yields stay in zone 1, well, then we will see higher rates ahead. Take a look at this chart here. This is the stochastic. I'm talking at this blue line here. I've cut out the signal line, so we're not looking at %D. I don't think it's necessary. So what we're just looking at is the %K, and it's hinged, it's turned, it's heading towards that 80. And if it carries on in this direction and settles in the 80 level, then we will see that expansion, and we probably will see the rates in zone 1, and then we're going to have to deal with the fallout from that. Now, that's the technical analysis. What's the fundamental analysis? And this is where it gets, in my opinion, much harder to come up with something as clear-cut as the technical scenario, because we still very much data dependent. So we've got CPI that looks like it's moderating. We also had the jobs data on Friday, which showed some signs of moderation as well. So those are only 2 data points. 2 data points don't make a trend. We need to see a trend of moderation. And I think if there is a trend of moderation, then I feel that the technical scenario must be questioned. How much higher will the rates go if we start seeing a moderation in the inflation data? This comment that I'm making, I would admit, is very premature. We need more information with regards to CPI. But what we can do to monitor it, let's just go through to this chart here. I want to come back to DAX COPOC in a moment, because it's worth just having a chat about that. But just before we do that, let's take a look at the core CPI. Okay, so that is the code USC for core. Okay, then CPI, and this is going to bring up our core number. We'll bring that up. All right, and what we would want to do here, we want to take the COPOC out. What we would want to do here is add in two indicators to monitor. So the first indicator, I think, is a moving average. So let's bring in a moving average. And let's put in a 3-month simple moving average here. So we're just looking at sort of the average over a quarter. Let's bring that in. Let's make it a little easier to see. All right, so we're kind of getting to a stage now where it does look as if we might move below that 3-month average, right? So we just want to keep an eye on that. And then what we want to do is add in an RSI as well underneath, which I think is also a good way to keep track of the core inflation. So we just add that in. And what I'm going to do here is just add in also a signal line. We're just going to make it a 9. That's fine. A little bit, make it a little bit more pronounced. Okay, so this is interesting. We're getting to a point here where it does look as if there is some sort of potential technical signal there. It does look as if there is some sort of technical signal coming in there. And let's just see how far back this goes. And we'll go through to the 70s. So here's the first oil crisis. Here's the second oil crisis. Let's zone in on these two areas. All right, so what you can see here is the RSI cross below, core CPI crosses below the 3-month average, and then we see it come down. And then if we go through to the second oil crisis, we've got a similar type of scenario where you've got the CPI cross down, and you've got the RSI moving below as well. And that's kind of what we want to watch for here. Now, there is an inherent there's an inherent risk. There's an inherent risk with what we've just looked at now. What's that risk? Well, there's a bias. Okay, technical analysis would always be susceptible to this type of bias. It's called a time period bias. In other words, the variables in the 70s are different to the variables that we are experiencing today, meaning that market behavior can be distinctly different. But I think that's the closest that we have to what we are witnessing currently. So we'll acknowledge the bias, okay, but it's the best we've got to work with, and we will see if there is going to be some moderation here. And what's the whole point of this analysis that we've just done? Well, it really comes down to what's going to happen to the real rates. Now, regardless to how the CPI or the core CPI behaves, I think for us the fundamental movement is still going to be the real rate. So if the real rates carry on moving up, let's just assume that the Fed, because the Fed's desperate to regain credibility, because they've lost a lot of credibility since the beginning of COVID. And to be honest, I don't think that it could have been avoided. I mean, it was, let's be honest, I mean, a really trying time to set policy and get it right. Nevertheless, there has been a lot of credibility that the Fed's lost, and that puts them at risk of overplaying their hand again. So if they carry on moving rates up, despite what we're seeing on the core, then of course real rates carry on moving up, and if real rates carry on moving up, they'll carry on rippling through and affecting the other instruments. So we're in a very difficult market, which is what we've been saying for the longest time. For almost the whole of 2022, I think we've been saying it's a very difficult market. The difficulty continues. We continue to monitor the real rate. Let's go through to sort of a conclusion now, just in what we're talking before we move on to other stuff. The fact of the matter is the DAX, a big one, and the real rate is in zone 1. The fact of the matter is the momentum is kicking up. The fact of the matter is the dollar is supported, all because of this. And this makes complete sense on a technical basis. And that's, I think, the current sentiment that we're in, and that's really what's going to affect us as traders. However, we must just keep this, this chart in the back of our mind and continue to monitor it. And then just to throw in the extra sort of variable that is, a complete sort of vagary. It's almost impossible to really analyze because it's never been done before, is quantitative tightening. My expectation with quantitative tightening is that, of course, it does support rates, but how does that fit in with the coming down of core CPI? So that's another variable that we're going to have to keep an eye on. All very difficult. Okay, I'm just taking a look. Anna's put in a YouTube video here. I haven't watched it, but of course I'm going to share it, and you can find it at this address. And she writes as follows: much worse in the 70s. Historian Neil Ferguson is warning. So I'll just send this through to you guys, and you can take a look at it. Just let me know if you haven't received that. Thanks for that, Anna. All right, let's go through back to DAX. Let's do some analysis on that. Okay, bear with me, just bringing this up. Let's get rid of the RSI. I don't want to use it for this type of analysis. Let's get rid of the moving average. I don't want to use this either. Let me get rid of it this way. And then let's bring in the COBOC. All right, so the COBOC indicator is to me, it's not, as far as I know, it's not really well known. It is, people do know about it, but it's not sort of mainstream in terms of technical indicators. and that's a pity. I think it's a very, very solid, very solid indicator. It was derived by a financial advisor by the name of Edwin Kopak, and it's used only on the monthly time frame, and it's used only to try and find market bottoms. The Kopak is not a holy grail of trading by any means. It's just an extra tool in your toolbox. It is susceptible to false signals, although I find that the false signals, thank goodness, aren't all that common. And what we want to do here is take a look at the Kopak relative to the 0 line. And what we want to do is see if it's below 0. Well, we're looking at the DAX on a monthly scale, and yes, it's below 0. Okay. Now, there are two triggers and both have to be pulled for Kopak. The first trigger is being pulled. It's below 0. It's below 0. The second trigger, of course, is that it has to turn up, and that's really the most important. So under 0 and turns up. So there it turns up, and then we get a nice swing. Here is sort of an early signal. Here you can see. So that, let's call that a whipsaw, but this was a nice signal here. This is 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 a good signal here, because remember, it's a monthly chart. We get a nice signal. Then, of course, COVID, which Kopak won't be able to make any sort of, won't be able to be discounted in the Kopak. So here's COVID. Then it falls to here, and we get quite a nice signal up. And then, of course, this is where we are right now. Does that mean we're near the bottom? And the answer to that question is no. It certainly does not mean that. It just means that we are in value territory. I was having this discussion with my dad over the weekend. So yeah, things are looking like they're valuable. Things are looking as if they are cheap. But of course, that doesn't preclude the fact that they could become cheaper. Okay, so yes, we are in a value phase according to Kopak, but you can see that the Kopak can drop much lower, right? We can go here, it's at minus sort of 67. So there could be still a lot of pain before it turns up. And what we want to try and do is be as objective as possible. So I think what we can do, and this was not part of Kopak's indicator, but it's something that I think is worth adding, and that's just a 9-period exponential moving average. So we just kind of add a single line here just to help us see when it does turn up. So we're just putting in an EMA, and we can take a look if the signal line here, it's going to be, but now it's going to be too much of a lag. Sorry, I'm going to just change it back to a 3-month. Okay, so that's going to be a better signal for us. Let's change it to a red. Okay, and let's add this, save as default. Okay, so theoretically, next time we bring up the Kopak, it should have this this red line in. And then what we can do is we can see where it turns up. Now, Kopak is challenging. I'll tell you why it's challenging in a moment. 1, 2, yeah. So the signals here seem to be pretty good. Pretty good. Okay, cool. So the challenge with Kopak is that it does almost automatically put you on a contrarian side of the market, which is not a comfortable place to be at all. And it's even worse to be if the Kopak gives a false signal, okay, because then you lose your confidence. But the idea here is, whilst the market is shouting, bear, 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 bear. The truth of the matter is the COPOC may turn up. And if it turns up and everybody's shouting bear, 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 and you kind of now thinking, well, maybe we've bottomed, it's going to introduce a discomfort. And then it's kind of, how do you manage that? Just to give you an example of what happened to me. So if you take a look at an index called the J200, which is the South African all-share index, okay, a big one is the top 40. So we just go through to the J200, and what happened to me is I was on a trading floor back in 2009, and I was speaking to a trader. Let's just make this 0. And I said to this trader, I think we're at the bottom. I think this is probably a good time to start looking for bargains. And the trader said, no, there's more pain to come. And I was coming purely from the COPOC indicator. So there'd been this vicious sell down in the stock market. So there's the global financial crisis. And then the COPOC had turned up. And it turned out in this particular case, okay, the COPOC proved to be correct. But the point is, I think this trader on the trading floor was being sort of bombarded by all types of information pointing to further bearishness. And then when it was time to probably look for bargains, I think that it was just an uncomfortable place to be. And I think that's just something that we've got to guard against. So we go back to the DAX, and everybody's shouting, that this is the worst place to be in sort of modern history. And the truth of the matter is, it could very well be, okay. But of course, the COPOC hasn't turned up yet. What's going to be very interesting for us is when the COPOC indicator does turn up and the market is still shouting bloody murder, because we've got to try and think if it's worthwhile being contrarian or not. Now, it's not always worthwhile being contrarian. So something that we've seen previously, if we go to the NASDAQ 100, okay, and we take a look at the tech rec, there is an actual false signal on the COPOC. So let's just bring that in. So let's just go back to the tech rec and the false signals here. False signals here. So it turns up, yeah, but yet there is one last leg down, and that's why I'm saying that the COPOC is not a holy grail. It's just an extra tool in our toolbox. So once we get a signal in the COPOC, we want to try and refine it a bit more, so that the sort of cognitive dissonance that we're going to be exposed to, I hope I'm using that phrase in the right context, but I believe that's something that we're going to be subjected to. The idea is, can we add in an extra filter to perhaps help us not fall into the potential whipsaws of the COPOC? And I believe that we can. I believe that we can. So how do we do that? We're just going to use a tool that we've always used. Yeah, we're going to add in our zones. So let's add in our Bollinger Bands into the NASDAQ. All right, and let's just go through the settings so everybody knows the settings that we use. So we take out the middle line. We don't need that. I just like using a blue, and I just suggest everybody uses the same colors, because then if you email me and you talk about the blue bands or the red bands, we're kind of talking the same language. So the inner bands I like making blue, and then we just change the standard deviation to 0.75. Okay, so we can do that. And then what we want to do is we want to just make the outer bands, we'll keep them as the 22s, and then we'll just change this to reds. Okay. And now we've got something that I think is quite workable. So what you have here, let's zoom into the whipsaw period for the tech rec. And you can see that this is the decline that would actually hurt if we only used the Copac. We would have gone long, yeah, and then we would have got hammered to the downside because there was one more down leg to come. This is a early signal, so it's a whipsaw, it's a false signal, which just makes which gives us a very clear warning to not take this at as a holy grail type of indicator. However, if we use the zone analysis, we can see that the Nasdaq never made it from zone 3, okay, into zone 2 until much later. It only made it right here. So now we've got a nice Copac signal, and it coincides with a nice movement from zone 3 into zone 2, and ultimately from zone 2 into zone 1. Well, that's a signal that we can work with. Now we go through to our DAX. Okay, so let's go back to the DAX. And what we can take a look at here is, of course, the movement of the Copac above a signal line, but we want to see the DAX move from zone 3 into zone 2. Once we move from zone 3 to zone 2, and we get the uptick in the Copac, then we can start looking at fundamentals. Are interest rates now starting to come down? If interest rates are starting to come down, that's going to support present values. If that's going to support present values, probably good value to be had in the market. Let's go hunting, right? And then we can start using other tools to hone in on hopefully what turn out to be good investments. But what's the big issue here? We're going to be on the contrarian side of the market. So once you're on the contrarian side of the market, it's a very uncomfortable place to be. We're not there yet, by the way. So it's just something to keep in your toolbox. What time frames am I using? Oh, I beg your pardon. No, the time frames are monthly. It's the I'm using the so we share this. I'm not sure why it's been changed back to -4. -4 goes back to New York. I'll just change this to Johannesburg. Okay, so if you're in the UK, you'll just change it to London. But the time frame here is monthly. Don't worry about this. Okay, it's well, you do have to worry about it, but in terms of the monthly scale, don't worry about it. Okay. Unless you're that kind of contrarian person by nature, of course, which I am not. But you're quite right, Anna. All right. So that's the DAX. Then, of course, so we've got effectively two things that we've discussed today, and I think that we'll keep this theme going for this week. We'll start drilling down into how the dollar's behaving versus real rates. We'll keep an eye on the DAX side of things. Just before we log off, I think it is worth a while just going through to not this chart, this chart. So it's not the right one. Let's just change this to the main layout. So what we can take a look at here is just go through to the US dollar. And what you can see here, if we go through to the daily chart, well, we've actually got a strong momentum on the greenback. Okay, go through to the hourly chart here, and we've got a strong momentum on the hourly, and it's quite tricky because the signal came back there. Okay, so can we get in over here? And well, if you take a sort of a long position, or you believe dollar is going to move stronger, you've got to keep an eye on the stochastic. If the stochastic remains above 80, that's probably the right way of looking at the market. If it drops below 80, then of course the market is starting to show slowing momentum, and then the dips in the uptrend become compelling. Similarly, we go through to euro US dollar, and similar analysis. We just go through to the daily. You can see that we're in zone 3. The momentum here is very much to the downside, and the question is here, is it worth taking a short on the euro at the moment? I don't have a position on. I would prefer to get in on some sort of pullback, some sort of risk-adjusted type of entry, but there is certainly a case to be made for a weaker euro. And take a look where we actually are in terms of pricing. You know, we've broken that 99 level. We've gone down, and I think that ultimately, as long as we stay in zone 3, as long as the stochastic remains under 20, and as long as the real rate in the US stays in zone 1, we'll see probably lower euro prices ahead. The key here is, of course, are you going to play the momentum, or are you going to try to catch the pullback? That's obviously very much a personal choice. I'm looking for the pullback. Rob says, if the euro is raising rates this week, this implies the euro will be bullish, so a pullback at the back end of the week. I think that kind of makes sense. I think that makes sense, Rob. I think what you've got to be very careful of, and again, I don't have the answer to this, but I think it's something that is certainly being discussed amongst market participants. And that question is, how hawkish can the ECB truly be? And it all comes down to what's being discounted. So I would expect that a large part of the euro's policy has been discounted into rates. I think the communication now from the euro, is it going to be believed by the market, or is it not going to be believed by the market? And what's tended to happen is that whenever the ECB comes out with a hawkish type of communication, there is a bounce, and it gets faded very quickly because the market just thinks there's no ways you can do what you're saying you're going to do, because you know, Germany's if it's not, it's about to drop into recession. You know, depending on how you measure recession, if it's if you're measuring about 2 quarters of contraction, then it's not in recession. But if you're looking at other measures, then I would suggest it's possibly is in recession. So your question is, of course, very important. And the fact of the matter is, the likelihood of a protracted hawkish ECB policy is not, of course, something that is 100% believable. I don't think it is. Especially if the Fed's doing sort of the heavy lifting for global inflation. Nevertheless, your point is certainly important and warranted. Rob also writing, just a thought, a raise by the ECB pushes the Italian bond rates higher, which they don't want. Well, That's the whole point. How hawkish can the ECB truly be? And I would posit that probably less hawkish than they would communicate. And I don't think you can fool the market. Very, very, very difficult market to analyze. Any other questions? Please go ahead, type this through. All right. I think what we will do is conclude at this point. Any questions, you can, of course, email me, and we shall try and unpack what we've discussed today for the rest of the week. One more thing, guys. One more thing. Thursday, we won't have a webinar on Thursday. I beg your pardon, but the rest of the days we will. All right. Chat to you guys tomorrow. Have a good day and a good evening ahead. Cheers.